Payback looks at the length of time it takes for a business investment to repay itself. Knowing this information is crucial in helping a business to assess levels of risk and to compare different investment opportunities. You don't invest thousands, or even millions of pounds, and not want to know when you'll get that money back. The faster that an investment pays itself back, the lower the level of risk that a business is exposed to, and the sooner the money can be used in some other project to help the business. So how do we calculate the payback period of an investment? Well, we start by constructing a cash flow table. Let's imagine that we want to build a new factory. This factory will cost us £50 million, so we add this as a cost into the year zero net cash flow column of our table as shown. This is a negative as it has cost us money, which is why it has brackets around it. Next we add the net cash flows for each of the subsequent years over the lifetime of our project to our table. These values are usually positives, the net returns that we receive from our investment. Now we go year by year and keep adding the returns to the cost of the original investment. So, in our example table, we are adding the 25 million to the negative 50 million, leaving us still short of £25 million at the end of year 1. If we keep going, by the end of year 2 we are left owing 15 million, and this figure goes down to just 5 million by the end of year 3. In year 4, we have an expected net cash flow of 10 million. If we add this to our table, we can see that by the end of year 4, we have repaid the full amount and actually now have a surplus figure of £5 million. Nice. However, Payback only cares about when we reach the repayment value of £50 million. So we need to calculate the exact point in year 3 that we recovered the full cost of our investment. Okay, so how much money were we still short of at the start of year 4? The answer is £5 million. Okay, and how much money are we getting in during year 4? The answer this time is £10 million. So we take the 5 and divide it by the 10, which gives us a value of 0.5, and then we multiply this by 12. Why 12? Well, this is the number of months in a year. If you are asked about the number of weeks, then change this to 52, or 365 for the number of days. By doing this, we can work out that the investment is repaid after exactly 3 years and 6 months. Nice. However, Payback also has its problems. This project kept generating returns into year 5, but Payback simply ignores any future returns beyond the payback period. It also ignores the time value of money, more on that in future videos, and fails to account for changes in the economy over the payback period. The longer it takes to pay back, the more chance there is of things changing like interest rates and inflation. Time is really important. Given that we struggle to even accurately forecast next week's weather, how much trust would you place in a projection stretching years into the future?